Have you ever had some finance bro talk at you about equities, bonds, portfolios, and you just tuned out? If that's you, we got you covered. Because today we're breaking down some of the most common products people invest in. We'll start with bonds and stocks. You can think of them as the basics. Then we'll move on to more complex products like ETFs and mutual funds. They're essentially many bonds and stocks packaged together. And then, of course, we need to talk about crypto. Crypto can seem like the most complicated of them all, but trust me, it's actually quite simple. And stick around until the end of the video to find out two of the most important investing principles. If you find investing complicated or overwhelming, you're not alone. According to a global survey about investing, 40% of people who don't invest say it's because they find it too confusing or simply don't know how to do it. Now look, what you do with your money is up to you. It's a completely valid decision not to invest. But either way, you should know the basics and feel like you're making an informed decision. And by the end of this video, you'll likely know a lot more than you do now. First up, we've got bonds. You know how when a bank gives you a loan, you have to pay it back and pay them interest too? Well, a bond is actually something quite similar. The borrower, in this case, is a company or a government who issues an IOU, essentially just a piece of paper with a promise to pay back the money at a later date. That piece of paper is the bond. Well, okay, today it's not a piece of paper anymore. It's all digital. Investors can buy the bond, and the company or the government receive the money, and the bond can be then sold in financial markets. So say I buy a bond for €100. That means I buy the right to be paid back those €100 in the future. That moment is called the maturity date. That could be, for example, after 1 or 5 or 10 years. It's the agreed upon expiration date of the bond when the company or the government must pay back those €100. Okay, so I get my money back when the bond matures. But of course, there's also something extra. After all, the company or the government are using my money in the meantime, and I don't have it for myself. That costs. Now, with financial products, the money you could earn or lose is called a return.
You can make a return on the bond by receiving its coupon. That's a periodic payment that the bondholder receives annually or semi-annually. That's embedded in the bond contract. So you are owed that money with some periodicity until the final maturity of the bond, so the due date when you actually get your money back. A way to actually profit from bonds is also not to hold them until the very final maturity, but to actually sell them at some point before that at a profit, at a higher price.
Still, when it comes to bonds, retail investors will typically hold their bonds to maturity because that's generally considered a safe thing to do. After all, you have an agreement with the company or the government that they will pay you back and make the fixed coupon payments. That being said,
all investments have a certain risk. In theory, it is possible that you do not get your money back from a bond. Having said that, investments in bonds are usually considered safe investments, especially if we talk government bonds.
Theoretically, the government or the company can go bankrupt. But especially with governments, that rarely happens. Next, we have stocks. Now, you may have also heard of people saying shares or equities and wondered, what's the difference? Well, effectively, there is none, so people often use them interchangeably. Now, imagine a company as a big pie. When you buy a stock or a share, you're buying a slice of that pie. You own a piece of the company. Now, owning a piece of a company sounds nice, but what does it actually get you?
Somebody who buys a stock receives typically a dividend, if that's a dividend-paying company, or a voting right, which allows the investor to have a say in the company's decisions and policies. A dividend is a payment that the board of directors of a company decides to make to shareholders based on their profits. And it's something discretionary. It's purely decided by the board. They typically are paid by companies that have a steady and predictable cash flow and want to return that to shareholders. Other companies might actually be in a high growth segment and they might decide not to distribute those profits immediately, but to reinvest them in the company in the hope that they can grow their business, increase their potential and for their share price. Sometimes investors can get voting rights and they can exercise them to influence companies' policies. They can vote on important decisions that affect the governance of those companies, for example, their environmental policies or how they engage with the public. And this is something that is valuable to some investors in particular who target not only profits and returns but also social outcomes.
Not bad. Something important to keep in mind though, stocks are usually riskier than bonds. So bonds are loans you give out, and stocks are pieces of a company you own. Now that we have the basics down, let's see what happens when you throw a bunch of them together. That's right, we're talking about funds. Let's start with mutual funds. Think of this pool as your investment. Instead of buying just one stock or one bond, a mutual fund lets you invest in a collection or pool of stocks and bonds.
Mutual funds pull funds from different investors. This is done professionally. Investors thus don't need to do this actively on their own. Someone does it for them.
So essentially, behind the mutual fund is a person, the fund manager, who actually knows the companies your money goes into. That manager keeps an eye on the fund, sees how it performs, and makes changes where necessary. For example, drop some companies if they're in trouble, or invest in rising stars. But how do investors decide if the person managing their mutual fund is someone they can trust?
When choosing a mutual fund, an investor would usually look at different criteria. For example, the reputation, the risk that the mutual fund is usually taking. For example, the values that the fund is usually subscribed to. For example, if an investor is very interested in protecting the climate, one would usually go online and search which mutual funds has on their website written in big capitals, we are investing in green investments. So these are some of the considerations.
But if you'd rather not have a fund that's managed by a person, there's another type of fund, an ETF. ETF stands for Exchange Traded Fund. And one of its key features is that your pool of stocks and bonds is usually tied to an index. So, what's an index?
An index is an indicator that tracks the development of different assets on the market.
Ah, right, assets. This is one of those words that people in finance use all the time. It basically means something you own that can generate money or other benefits for you in the future. Think a house, or in this case, stocks and bonds. But back to Christina.
If you think Germany, for example, the DAX would be such an example.
So, in the case of an ETF, usually there's no one actively picking stocks and bonds. Instead, the value of an ETF simply follows the overall performance of a pool of stocks and bonds that was already defined in advance. But that leaves the question, which is better, a mutual fund or an ETF?
Both mutual funds and ETFs have advantages and disadvantages. So if we look on one side at mutual funds, the investment is performed by a professional. This means that this professional is paid. At the same time, he or she usually has experience. They're, so to say, professionally done investments. On the other side, ETFs are passively managed investments. This means that investors are not on a daily basis doing this professionally. ETFs usually have also much lower fees that are charged for their management.
In both cases, investors often see one big advantage over owning individual stocks or bonds: diversification. So why is that important, you ask? Well, keep watching to find out. Okay, now that we've covered stocks, bonds, mutual funds, and ETFs, are you still with me? Because now comes the one many of you think is really complicated. We are talking about crypto. Now, most people have heard of Bitcoin, but there are many, many others. So what exactly is a cryptocurrency? The first thing to know is, crypto is not actually a currency.
You normally can't pay with it in established contexts like in a shop, grocery, and the like. People use it to invest, to speculate, and some say gambling, which is you give money into it and hope that you get more back.
Gambling, huh? What makes you say that?
Financial assets are normally
characterized by a cash flow. Different assets have different cash flows. For example, if you buy a bond, that bond pays an interest. If you buy an apartment or real estate to invest in, you get the rent. If you buy a share, this share pays a dividend. So based on these cash flows and the prediction on the success of the asset in the future, you can calculate the fair value of a financial asset. Crypto like Bitcoin doesn't generate any cash flow. So that means you cannot calculate any price based on the fair value based on cash flows.
So keep in mind, crypto can seem exciting, but unlike stocks or bonds, it's not tied to any real economic activity. The way people make money is, well, economics has a name for it.
There's a theory called create a fool, and it's less funny than it sounds. It's actually serious, and it works like I invest in something, in a product or in crypto, and hope I find a create a fool who will, at one point in time, pay me more money than I paid for it. So I need to find a create a fool, but the problem with this, like with many other schemes, is that at one point you run out of create a fools.
So there you have it. Unlike the other investment products we've talked about, crypto doesn't generate cash flows, no coupon payments, no dividends. So if you do decide to buy crypto, just make sure you understand the risks. Which brings me to something else I promised to talk about. The two most important principles investors think about. Number one is diversification.
Investors usually consider two main aspects. One, diversification. It's very important that the investment portfolio is diversified. The golden principle is don't put all your eggs in one basket.
Exactly. It's usually a good idea to spread investments across different assets, products, industries, or regions. Investors try to avoid a situation where all their investments react the same way to bad news or changes. This reduces the overall risk of losses. Speaking of risk,
the second principle that investors usually think about is the principle of risk. This means that the riskier a product, an investment product, the higher the expected return.
if someone offers you, say, a 50% return on your investment, that's really high. And it sounds enticing. But they're offering you such a high return because not many people are willing to invest in that particular venture. And that usually happens when it's really risky, which means you might only get back some, or even worse, none of your money. Conversely, the promise of lower returns usually means that the investment is relatively safe. And if this wasn't enough for you, here's a little extra: the investment horizon. Investors tend to think about how long they can invest their money and when they'll need it back. Some financial products tie up money for a while, and some are easier to convert back into cash than others. Some even require a third party to do it. In other words, if you're thinking about investing, be clear about your timeline. So that's it. 5 financial products explained in plain English. And remember, the 2 golden rules investors tend to go by are diversification and understanding the risks they're dealing with. Did you find this video helpful? What other money topics would you like to know about? Let us know in the comments. And don't forget to like and subscribe to Espresso Economics.